It seems that the rally right now is getting stronger and stronger. We're getting muted sessions like we saw yesterday in the US and in London and of course in Asia this morning as well. But the general theme is that there's a lot of euphoria, a lot of optimism. Where to from here?
Look, I think that the market has become euphoric. You're quite correct. And I think the market is euphoric because they're happy they're alive. As compared to 6 months ago, where the market was really concerned about the longevity of the banking institutions, financial services institutions generally, and just the knock-on effect on the global economy. I think, though, that the big thing that one has to take into consideration, though, is that the leverage that one had in the economy before the crisis started is probably nothing like the world has ever seen before. And you've seen this massive government response, and it really has been a debt response because government has had to spend huge amounts of money. And we see the latest of that now happening with this cash for clunkers type bailout that's happening in the US. So the debt that they're using in order to try and just spin the economy and continue to spin the economy continues to amaze me, and I think continue to amaze most of the analyst community. Debt to GDP now in the US is sitting at a huge and astronomical number of over 150%. Now, the knock-on effect of this is that you need to try and make back money. If you look at a business, you can't survive if you've got a huge amount of debt. You need to create income to pay off your debt, and that is what the US economy is trying to do. The knock-on effect of this, though, and this is what the big issue that's playing itself out in the US at the moment, is the fact that they've got anemic growth, the fact that they've got tax revenues that will probably stay low for longer, the fact that the inflation is not really moving, and an aging population and far more pressure on the social net, not only at national level, but also just at the different state level.
But Cobie, if they didn't acquire all this debt to try and bail out these sectors, then don't you think that the US and the global economy would be in an even more dire situation?
Look, interesting enough, the US, this is the first time the US has ever done something like this. Or shall I say that it's done to this magnitude. If you go back in history, look at 100 years worth of economics in the US, you'll see that they've gone through crises to this degree where bailouts haven't happened. You're quite correct. The knock-on effect in the economy is half a decade of very anemic growth, or a decade of a recession that lasts for long, long periods of time. Certainly, if you look at the situation, yes, it was necessary. And yes, it's something that will help the economy long term. And yes, hopefully this will start creating inflation. But the question is when. At the moment, the market is pricing in a very euphoric type situation where they believe that inflation will start ticking very, very soon, maybe 6 to 12 months out, and that'll start feeding through into earnings numbers and could potentially start raising taxes and so on, and the debt burden will start decreasing. But what if it doesn't happen? If that doesn't happen, what happens with markets from these points forward?
So you're saying deflation is still very much a threat, even though we're seeing quite a lot of quantitative easing. We're seeing the dollar weaken quite substantially, and that's about all the money going into the market. So in what you're actually trying to say, deflation is more of a risk right now.
Well, deflation, it's at a tipping point where the economy has to choose a path forward, and it's really the American people that will choose the path forward. And that it's not just an American problem, I think it's a Western world problem. And the tipping point is between deflation and inflation, and what would that look like? The thing that continues to concern me, and I think much of the analyst community, is that you've gone through a period of 2008. It's been this massive, massive event, and it's as if nothing has happened. Yes, the markets are down, but yes, look at the appreciation that you're seeing in the markets,
So how do you pay off debt if you can't really create revenue and generate revenue? We know that the US consumer is under severe pressure. Unemployment is rising in the US right now.
Well, look, it becomes a tough situation for an economy. Usually, what happens is it takes time for these things to play themselves out. It often needs it needs a focus by people or citizens of a country in industries which potentially have lost favour and has been given out to other countries. And it just takes an emphasis back to work and trying to get the economy going, and back to kind of the age-old adage, a dollar in the bank or a dollar saved is better than a dollar spent. And potentially, and that takes time, and it takes effort. And then often the knock-on effect that we saw, if you go back, look at 100 years worth of history as far as economics are concerned, often these things could potentially go hand in hand with world wars, potentially, because people aren't happy with their lot in life.
Well, quite a bleak picture that you're painting there. In terms of the equity markets, are you foreseeing a pullback, and to what extent?
See, the South African market is an interesting animal because we need the commodity cycle to turn in order to make sure that the rest of the country turns. The commodity cycle turns regardless of who the client is. If it's the West, it's great. If it's not, if it's the East, that doesn't matter to us. It really is a commodity cycle that we need to start turning. And we can see that, we can start seeing that and start seeing signs of that happening. So the South African economy is probably slightly in a slightly better situation than the Western world is out there.
Do you see us decoupling from equity markets globally?
That could very well happen, yes. I'm not saying the probability is there that it could happen. I mean, for investors today, the big thing is if you've got money to spend and you've spent money in the equity markets through October, November and December and right through into March, you've bought equities and you've made lots of money out of equities. And if you own some more cash, hold it and see what happens. If you're prepared to own equities for 20 years, well, buy today.
So would you go into the markets today at these levels?
Well, if your holding period is for 20 years, certainly, yes, because it continues to be cheap at these levels. But if you're quite happy to asset allocate and you continue to own some equities and maybe you want to own some cash on the side and wait for opportunities, absolutely.
Well, Cobie, many investors were panicking to get out of the markets beginning of the year. Now they're panicking to get in and they're not really sure what to do right now. In terms of what you foresee happening by the end of this year, do you think that we're going to see another significant slump?
Could be.
Could be.
Could be. I'll tell you why I say so. It's because the world has become completely euphoric about being in the markets. It's all of a sudden okay to own companies again. And that turnaround has happened exceptionally quickly. The turnaround from being completely pessimistic about the world and worrying about if the banking industry is actually going to survive to today has only really taken 6 months. And that is not a very long period of time. And that's why I believe that at some point people will start saying, well, hang on a second, the world economy has to deal with a whole bunch of other knock-on effects of a massive debt burden. And at that point, you'll probably see a sell down.
And of course, a lot of the bad news has been priced in already.